Second part, types of risk. Suppose there are announcements and news on stock, and this contains both expected and surprise components. Expected factors are already reflected by current market prices because they're already expected. So surprise parts affect stock price changes. And we can divide surprise component into two: systematic and unsystematic parts. The first one is the factor that affects a large number of assets market-wide, called systematic risk. This risk cannot be avoided since this is market-wide. So this is also called non-diversifiable risk or market risk. Typical examples are changing GDP, inflation, interest rate, political events, regime changing, and so on. The second factor is the one that affects a limited number of assets, unsystematic risk. This risk is only related with single or small number of assets. Examples are labor strikes, parts shortage, CEO sudden death, and so on. This risk can be avoided by diversification, adding more assets in portfolios. So this is also called diversifiable risk, unique risk, asset-specific risk, or idiosyncratic risk. Figure 11.1 shows average annual standard deviation by the number of stocks in portfolio. Purple part is systematic portion of the risk, which is market risk. So that is the minimum level of the risk that cannot be diversified away. It is about 19.2% standard deviation. The green part is unsystematic risk, which can be avoided by adding assets. With one asset, average standard deviation is 49.2%, and with 10 assets, it is 23.9%. With adding additional assets, the standard deviation always decreases, however, at a decreasing rate. With 30 to 40 stock, we can eliminate most unsystematic portion of the risk. Forming well-diversified portfolios can eliminate about half the risk of owning a single stock. Now, how to show the level of systematic portion of the risk? First of all, we all know that there should be a reward for bearing risk. However, as we discussed, markets do not give a reward for wrong choices, not eliminating unsystematic portion of the risk. So the expected return on an asset should depend only on that asset's systematic market risk. We can measure the level of the market risk by stock's volatility relative to market, called beta coefficient. If the beta coefficient is equals to 1, it means that an asset has same level of the risk as market. If it is higher than 1, an asset is riskier than market, and if it's below 1, then an asset is less risky than market risk. From the definition, beta of market is 1, and beta of T-bill risk-free asset should be 0. Finally, since we eliminate possible diversifiable risk and beta show only systematic portion. Portfolio beta is simply weighted average of each beta coefficients in the portfolio. Beta coefficients are usually found by statistical analysis called regression analysis. We are not going to learn how to get them in this class, but you can easily find beta coefficients of companies from many websites, such as Yahoo Finance. The table shows beta coefficients of selected companies, and note that beta coefficients also changes. It varies by time. This example shows the difference level of the total and systematic risk. Security K has higher standard deviation than C, meaning that total risk of K is higher. However, K's beta is lower, so K has a substantial portion of unsystematic risk and can be eliminated by forming a well-diversified portfolio. Because expected return is only related with systematic risk beta, C must have higher expected return than K. Finally, if weight C is 45% and weight K is 55%, portfolio beta is simply weighted average, which is 45% times 1.25 plus 55% times 0.95, 1.085. Third pop quiz. Find portfolio beta of the following investment. You can use Excel template and round up to 2 decimal places. Bring up Excel template. By clicking Excel icon, we can compute the weight of each stock, amount invested, divided by total investment. In column F, beta times weight and add them up. Portfolio beta is 1.13. This is the end of part 2.